Good morning. Thank you all for joining me this morning. And one of the topics I wanted to just touch on today is how to calculate debt to income ratio. Debt to income ratio is a very important thing. It's the ability to repay a mortgage. So it's probably one of the number one or two items that a financial institution is going to look at. So here is a brief review as to how to do that. And you can switch out these numbers specific to your income, your debts, but this is just going to be an example. So how to calculate it? You'll first go ahead and take your annual income. You want to figure out what this is on a monthly basis. So $100,000 per year divided by 12 months. So that comes to be 8333 per month. Now, one of the things that an underwriter or the financial institutions are going to do is basic rule of thumb is we want to stay underneath 45% debt to income. So to figure out what 45% is, you take your monthly income and times it by 45%, or if you're on a calculator, times it by 0.45. So 45% of this is 3750 per month. So that's what we want all of our debts that show up on our credit report to stay under. That can be credit cards, auto loans, student loans, RVs, plus your anticipated mortgage payment. So we first can take out what those current expenses are. So we see, as an example again, maybe we've got $100 in minimum credit card payments, 350 car payments, and then $250 in student loans. So our total current minimum payments on our credit report show $700 a month. So we're going to subtract that out of that 45% number. So 3750 minus 700 is $3,050. So that's kind of our maximum housing payment amount. Now, what's included in that housing payment includes principal and interest, homeowners insurance, property taxes, PMI if applicable, and homeowners insurance or homeowners association dues also if applicable. These figures are based on uh, rates as of today, September 22nd, on a $400,000 purchase or loan amount of $500,000 purchase price. So principal and interest is 2763. Homeowners insurance approximately $75 a month, and property taxes approximately $200 a month. So what that comes to is our total housing payment, 3738 per month. Now that again does not include PMI. It also does not include homeowners association dues. So if you didn't have a 20% down payment, or if there's HOA dues, you would have to account for those, and that would actually push you up over that 45% threshold. Now, one of the things to just keep in mind is a financial institution is typically going to say, okay, your maximum debt to income ratio is going to be 45%. Now, that's what you can qualify for. Great. You also need to just take into account what do you feel comfortable with. Uh, that 45% number, it's before taxes have been taken out of your monthly income. So it can stretch thin at times. There's a rule of thumb that say, hey, you want your debt to income to be closer to about 35 to 40% to account for those taxes that are coming out. But other than that, I hope this video has been helpful as to how to calculate that debt to income ratio. If you have any questions, let me know. Other than that, hope you have a great day and a great weekend.